So how we doing? Today is Thursday, October the 19th, 2023. Just doing our Thursday night deal review. We'll be looking at live deals, whether it be a regular note deal that's for sale, somebody created a note and is looking to sell it, or we'll be looking at deals where we can create the financing for the deal to purchase it and give somebody a solid return based on the money that we need in order to take down the deal and do the deal. So one where we create the note, and the other one where where it's already somebody's already created it. A person's been living in the property for a certain amount of time and they're looking to sell it. It could be performing, could be non-performing. Starting out this week, we will do performing. So let me share my screen here. So that. Where are we at here? Bang. So you can see here, this is a property in Canton, Illinois, 737 Anderson Place, Canton, Illinois. And what we look at is the asset price. We look at about 3 or 4 things initially so we can, say if this is something that we want to consider. You have 2 levels of what we call due diligence. First level is just to see if it fits kind of the basic parameters that we have for finding a deal. And then if it does, then, we can make an offer on it contingent upon a second level of due diligence. So in this instance, I'm trying to stay in some of the lower price band of assets. I'm not trying to get too expensive. I mean, you can see assets that are, 50, 60 thousand, $100,000, but I'm trying to stay in the lower price band phase for this to show people that, you don't need as much money as you may think if you're looking to invest in real estate to get yourself a solid return. So this particular property here, like I said, is in Canton, Illinois. And when it was originated at $31,000 back in 2010. The status of it looks like it's saying that it is performing. And the remaining balance on the note is $18,797.42. And it looks like this particular seller is asking about $17,000 for the note. And when it was originally written at $31,000, it had a interest rate of 10%. So that would mean that, let's just say if you spent the whole $18,797.42, you would be getting a 10% return on that. But when it comes to notes, we never pay face value for the note, or what they call par, which would mean paying exactly what is left on the unpaid balance. We always get it at some form of a discount of the unpaid balance. And then also we want a discount based off of the property value. So in this particular property back in 2010, this property had to be worth at least 31,000, because they wrote it at 31,000. Usually you don't see them writing a property at 30,000 and it's only worth 10,000. It has to be somewhere in the range of what the actual price of the collateral of the property is. So, it's safe to say that in the last 13 years, that this property is most likely worth more than the 31,000. So really quickly, we just take this and we do a quick search. We just look at some of the free sources out there. There are some other sources out there where you can, pay for, that'll give you a more accurate sense of the value of the property. But for this, exercise, we just kind of look at, some of the free online things that are out there. So on Zillow, it's really not giving us anything in terms of a value. Go to realtor.com. Realtor.com is saying that's estimated at 59,000. So that makes me feel really good, let's just say this realtor.com was correct, or if it's least in the ballpark, you would be spending right now, if you paid the 17,000, you would be investing in an asset or something that is worth almost $60,000. So if you took 17,000 and divided it by, let's just say, 55,000, your investment to value is only 30%. So that means that you have a lot of cushion, a lot of wiggle room here. If things didn't turn out the way that you thought, if this person stopped paying, if there was a problem with it, life happened to the person and they had trouble paying or something like that, and you had to get this property back, you're only in it at about 30 cents on the dollar. So could you not, get the property back at whatever time and then unload it for 40 cents, 45 cents, 50 cents on the dollar? There's a really good chance that, that would be the case, that you could do that. So let's try and look at another one. Let's go to Redfin. And we try to look at 2 to 3 different sources to get an idea. Now, this Redfin says 57,000. So when they're that close, 59,000, 57,000, I'm feeling really good that this property is at least, $50,000. I don't believe that these will be, 20, 25, $30,000 off. Could it happen? Of course it could, but the likelihood of that happening is not likely. And like I said, for this exercise right now, I'm feeling good about it. Now, if you want to, then move forward on this, we would, go get a BPO or something like that, something a little bit more substantial to solidify the value, so we can make sure that it's at least in that, $50,000 range. So that checks, one of the boxes, where for what they're asking for this particular asset, and this person too, they've been in the property 13 years. And if you can look at the unpaid balance based on, what they originally bought the property for, they haven't missed any payments. This would probably be more than 18, to probably be in the 20, 22,000 range if they had missed a payment somewhere along the line, missed a few payments or whatever the case. But this has been amortizing down, as it should. And then they have the payment history here that we could take a look at. We also do that if we have that information, if they provide that information to us, we look at that. So this is only giving us basically 3 payments from, actually 2 payments from July and August. So, we would then go back on this and say, we'd like to get at least the last 24 months, 12 to 24 months of the payment history, just to confirm that this person has been paying. But based on these numbers, it looks like, that they have been paying. And so the likelihood, again, now, what is the likelihood after 13 years and them building up a certain amount of equity and then paying, that they would just walk away from the property? It's very low in this instance. If anything, if they got into trouble, what would they do? They would most likely sell the property. And then they would have to sell it and make sure that this unpaid balance, whatever it is at the time that you own it, gets paid off. So you would collect payments for however long before they had to sell it. And then at that particular time, get a lump sum at the end. So again, some of the initial things that we look at are looking good. The other thing with this, we try to look at neighborhood information. Let me find my neighborhood. Where's that at? I think it's over. Where is the neighborhood stuff? Where is it? Demographics. We try to go and look at, yeah, there we go. Best places to live.net is the site. We take that address and we pop it in Canton. Illinois. And we try to see what's going on in terms of the neighborhood, see if there's any statistics. Right here, we didn't find anything. What else do we got? I think we can go to, I think Trulia gives us some stuff as well. Trulia.com. To give us a sense of, crime, certain stats like that. I think Trulia is one of them that does that, if I'm not mistaken. Schools. So it gives you some information. Obviously, the schools aren't that great, but then we have to consider too that this is a lower price band area. Not every area is going to be like a 7 out of 10, 6 out of 10, 8 out of 10. Because this is in a lower priced area, that doesn't mean that they don't work, that they don't send their kids to school, that they don't live. Obviously, like you said, this person's been there for 13 years and been making the payment. So, we can't, put too much emphasis on, obviously you don't want to be in a war zone. If something is really bad, high crime, a lot of murder, stuff like that, you want to, kind of be careful with that, because again, if you have to take the property back, you putting somebody else in there, could be a concern. But for something like this, what I would do also, since there was no public information here, let me go to neighborhood.com. I think that's one, neighborhood.com, and see if there's something there. What we could do is reach out to, that they closed. They don't have that site anymore. That was neighborhood.com. Best places to live, neighborhood. Oh, Home Facts. Here's another one. So there we go. This is another site that'll give it to you, but you could call a local real estate agent, somebody in the area, and say, hey, I'm thinking about purchasing property in this particular area. Can you give me some information about it? So the crime here says moderate. So it doesn't seem to be like in a high crime area where you have a lot of risk. Obviously, like we said, it's in a, lower price band. So it's not going to be, the middle or upper middle class, probably going to be a working class neighborhood and things like that. So, and like I said, just for this exercise, these are just some of the things that we look at initially. Now, if you're somebody that, that's a big issue for you, then, maybe it is that you don't look at this particular asset. But again, I think that you have to kind of have, temper your expectation. Like I said, you're probably not going to get the best of the best, or the higher side of certain things when it comes to the demographic in the area when you're dealing in this lower price band. As you move up in price point, you can expect some of those other things to be a little bit better. So I'm going to look at the amortization schedule here, because what we do is we like to know what is the return that we're going to get. So if we were to buy this at $17,000, and it looks like from what the information said that it had 18 payments remaining. 88. So as you can see here, it says remaining payments 88. So we pop that in, 88 remaining payments. $299.16 is the actual principal and interest. And that's what you're concerned with. That's the money that you're going to get each and every month for your investment. You don't count taxes and insurance because that is usually escrowed. And then obviously that goes to the city and to the insurance company. So it doesn't come to you. So all that comes to you is the principal and interest. So here we're making 12%, almost 13% return on investment that is backed by a property where we're only in it at 30% of the actual value. So a lot of this right now, if I have this type of money, I'm looking to make an investment, I'm looking to get a solid return. 12.8% is pretty good on this amount of money. And like I said, you're safe, in case something does happen, you had to get that property back, which is unlikely. What'll happen is that most likely this will pay off before, before it went to foreclosure or anything like that, based on the potential equity. The property over the 13 years has doubled. So I don't think anybody would want to lose that just because something happened to them, with life. So, those are the things that, like on Thursdays here, this is what we try to do is bring these types of deals, these lower price band type of deals. We'll also look at some of the more expensive stuff, but for today, we'll deal with the lower price band when it comes to notes. So, I would feel encouraged by this. The next step would be then to kind of look at public record, make sure that the person that is selling it, this 7E Investments, that we see their name on the deed, on some of the public paperwork that is filed, make sure that it all matches up. Also, what we do is we try to follow the chain of title through public records. Sometimes, depending on the city, the county, and their records and how they file things, sometimes you can see back 3, 4, 5 owners, or if it's only maybe 1 or 2 owners, you can see, that it transferred and now it's in this particular owner's name. And then again, we will verify that, if we continue to move forward, but we can kind of look at some of that stuff initially just to see. And sometimes when you look at that public record information, it'll actually develop a story for you. Sometimes you'll see that this particular person bought it as a foreclosure. Maybe they bought it as a foreclosure, they put some work into it, and then they sold it with financing. And then now they're looking to cash out after collecting a certain amount of payments. So this one, like I said, has been around for 13 years, just depending on when this particular owner bought it. They just may say, look, I bought, a few years ago, I've collected all of these payments and I want to cash out. And that's what we're seeing now, is that some of these people who purchase these types of notes, especially in the lower price band, they are trying to liquidate these assets so then they can kind of go after some of this other stuff that's out there right now. You have some more of these commercial opportunities. You have some more maybe better note deals that they'd like to get into. So they're starting to unload some of this stuff so they can get that cash on hand to take advantage of some of these other opportunities. And it gives people, again, that don't have a lot of money to get themselves involved in real estate and get a solid return. Like I said, close to 13%. You can't beat that. And who's to say that they may not take 16.5 or 16,000 for this? You can put an offer in and see what they accept. These are great too for someone that has a IRA. If you're not retiring for another 10 years or something like that, there's still 7 years worth of payments here. You can move this and have your money moved into a self-directed IRA, purchase this, let it sit there, and then if you take the 299 payments and multiply it by 88. So 299, I think it was 12 times the 88 payments, on a $17,000 investment, you've made over $9,000. Solid return over that time. And it's just sitting in an IRA that you're, going to use down the line. This is why notes are a great investment for something like an IRA where you're, looking for that money and, down the line. So that's just one example. Again, each Thursday we'll kind of go through these examples on stuff that's out there because new inventory comes out every week. And then the other thing that we try to do on the deal review is look at how we can create notes on properties. And the way that we do that, and I'll take you through an example here, is we try to get private money so we can purchase a deal, have the private money, secured against the property. It's a loan to our business, but it's for the purchase of this particular property. So it will be a lien against the property, most likely in second position. Sometimes it can be in first position if we are dealing with someone who is seller financing a property to us. But in this example here, we'll be taking over someone's debt. So the money that we borrow will create a note and a lien against the property in second position. So this particular property here, is in San Antonio, and I'm gonna show you what the property looks like. So you'll see it for yourself. So as you can see, you know, it was a fixed up property. Doesn't need any work. Everything is new in there. So, you don't have to do anything for this one. So that's the property itself. And so you don't need any repairs. The value of the property is about $235,000. There's a small back payment of about $2,300 that's owed. And with the money that we borrow to do this, it'll pay that off and allow us to get into the deal. And then I'm going to show you how the deal kind of breaks down based on what we'd sell it at. So we, look to sell this property at $240,000 after we, took it down. What we're going to do is that we're going to buy it, and then we're going to offer seller financing or create financing for an end buyer. And the end buyer is going to go in actually third and fourth position behind the loan that's already there, plus the private money that we borrow that is secured against the property. And then once we create our financing for the buyer, they're going to go in third and fourth position. So again, the person that's lending us the money is still in a secure position. If anything happens to us, if for whatever reason, we disappeared, we walked away, your money is secured against the property, and then the payments that come in from it would then go to you. So, you would actually probably get more money if we, for whatever reason, fell off the face of the earth and stopped paying or whatever the case may be. Our buyer that's in there and they're making their payment, that payment, then goes over to you. So you're secured against the property. So we would offer that $240,000. I think right now it's on the market at $235,000, but nobody is purchasing it. But when we offer financing, we open up to more buyers. Right now in the market, people with 650 credit scores up to 700 sometimes are getting denied for loans just because credit right now is tight. Banks want the best of the best. Their liquidity has kind of dried up with the conditions that's going on in the market. So you have a lot of people that have decent credit scores, may have a bump or two on their credit or something like that a few years ago or whatever the case may be. And banks are not accepting them or not approving them for the loans. So now we're opening ourselves up to those people, and it gives us a bigger pool of buyers, somebody that can't go down to a Chase or Wells Fargo, whatever the case may be, for whatever reason, get qualified. They see that we're creating financing for them. This is what we're going to create for them. So we'll be looking for at least 10% down. Sometimes we can do 8, but we like to do 10 or more. We want the person to put down, be invested in the property. A lot of these people who are getting denied do have a good amount of money to put down on a house, but for whatever reason, the banks are not qualifying them. So we'd ask for 10% down, and then we create this loan here, this $180,000, and there's also this $36,000, which is the difference between that 10% down of the 240, and the balance is the 180 and the 36. And we would charge them 10.5% interest on both loans. And you would see here that the payment, $1,646.53, and then $329.31, roughly, $2,000, which, is reasonable for a house that's, $240,000. So that would be their payment. This is where our financing would come in. So again, someone maybe that has a IRA or some type of retirement account, this would be a great deal for them, because what we're offering them is to pay them 18% for 60 months, fully amortized. So that means that this is going to be fully paid back to you, this $35,250.92 in 5 years. So in 5 years, you've made an 18% return on this $35,000 and it's secured against the property. So if anything happens to us, you know, you don't have to worry because this buyer that's in there that's paying that, you know, put $24,000 down, you know, is making their payment and everything like that, you're still secured against the property. So in this one, you know, we actually, as the buyer of the property, we have a negative cash flow within this 60 months, but we're okay with that because of the bigger payoff down the line. If this person refinances at a certain time, maybe the rates go back down to, you know, 5%, 5.5%, and they've paid us for 2, 3, 4 years. And, you know, now they're able to go to that bank and get, you know, qualified, get refinanced. You know, maybe they do that at that particular time, but we'll still have a significant payoff at that time. So if they do that, you know, we'll make the money on the back end. So for, you know, basically paying out $65 a month, you know, we're okay with that. Another reason why we're okay with that is because if you look here on the analysis, you know, once, you know, we put our buyer into the property and collect the down payment and all the expenses that we had, we're going to clear about $7,200. So even if I took $65 times 60 payments, that's just $3,900. So the money that I get up front from the deal when somebody, you know, when they get into the property, once we've, you know, and what we do is we qualify them. We send them to our RMLO. We make sure that they can afford the property, make sure that their ratios are, you know, what they need to be. We're not stretching people too far. We're not, you know, having them at 55, 60% debt to income ratio. We're not doing anything like that. We're making sure that these people qualify to make this payment based on their income, you know, with a loan originator. So, you know, you know that they're qualified for this particular property. So as soon as they, you know, we pick them, we put them in there, we're going to make $7,200 once that second transaction has happened by putting the buyer in there. So I could take $3,900 and just put it in an account and just let $65 come out over the 60 months. And then I would still walk away with over $3,000, close to $4,000 on this deal. I think that's a good deal. And then, like I said, the payoff for me, if it goes past the 5 years, I start to collect all the cash flow as opposed to what we were having to pay out, which was I start to collect this $958.63 after the 5 years. So, you know, I'm okay with that, making a little money up front and then waiting for that payoff on the back end. And now this is a deal too where, you know, a wholesaler or another type of investor, they can't buy this property with cash and then turn around and sell it and make, you know, the type of money that we're going to make on it, because it just doesn't make sense. The numbers don't work out. And then here it'll tell you on this, you know, as a rental, it says gross monthly cash flow on a rental is, you know, almost minus $1,100. You know, so it doesn't make sense as a rental either. You know, because of what that underlying mortgage is, and then what you'd have to rent it at. You'd have to rent it, you know, probably close to $4,000, and that, you know, just doesn't make sense. At least $3,500 or something like that, and it just doesn't make sense to do that. So, you know, our strategy again allows us to make some money up front, and then, you know, get a larger payoff. So, you know, and like, you know, usually these particular can go about 10 years. So if you look at in 10 years, the total profit after 10 years is over 130,000. And that's what, you know, that we're banking on later on down the line, if this person stays in it 10 years and then sells it or whatever the case may be. And then there's some other things that we could do at that particular time. You know, when that person wants to sell and cash out, you know, they be based on their amortization schedule, they may be owed $20,000 or $30,000 at that time. Maybe we can give them that cash and keep this particular loan that's in place, that's still being amortized down, because I think on it we had how many months remaining? Yeah, you see here, it was 331 months remaining on this. So in 10 years, it's still going to be like over 200 payments left. So I can get cash at that time, pay this person off. They can take their little cash and go and buy another house or whatever. And then I can do this again. And then it starts over again on a 360 month basis with another buyer. So that's why, taking over these loans is what we want to do, and why it's so attractive, because we can keep this in place for, pretty much forever, really, because even when it gets paid off, now I own the property, I still now I have a free and clear property in, whatever amount of months. So these are the things that, that we look to do. We look to try to offer people those notes in those lower price band. We can find those particular assets for it. We can partner. We can do different things like that on it. And then also what we look for is for private funding to come to the table, get a good return. Like I said, that was 18%. Now, if I can find someone that may have 35,000 that wants to do it at 15%, I mean, then the deal is even better. Now I'm making $200 a month. Now I'm positive with my cash flow. That works out tremendous. I'll even take 16%. 17%. So even with 18%, I don't know what happened. I must have not hit the solve on it, and because I don't think I changed anything. I just didn't resolve it. But I'm actually making $157 a month right now, as opposed to the 65 that I thought that I'd be paying out. I'm making $150. So 100, almost $160, and I'm still paying a private investor 18%, fully amortized over 60 months. So to me, that's a great deal. And these are the types of deals that we find that are out there. I can show you, a lot of these that we look at and we evaluate. I'll just show you the ones that I've kind of looked at and evaluated. If you look here, it's about 20 deals right here. Not all of them were slammed with this good, but more than half of them, were good deals. So, this is what, we try to do each and every Thursday night, look at different opportunities that are out there. If you know anyone that, maybe looking to place money, you can invite them, and we can kind of go through this and show them, what's out there, what other opportunities that are out there. If you'd like to take advantage of it, we can have some conversations. I don't know if you have any questions or anything, but I think you can unmute yourself if you wanted to ask anything before I go. Yeah, I think you can unmute yourself if you want. Did you want to ask a question or anything?
Yeah, actually, I did want to ask. Hey, how's it going?
I'm all right. How you doing?
Pretty good. If you can, because I logged on a little bit late. I'm not sure if you went through it, but the 36,000 that you was just talking about, was that money that you borrowed to purchase the house? Was that the down payment for the
That's
200?
like our entry fee to get into the house. There was like a small amount that had to be paid. Let me go back to sharing the screen again. I'll show you exactly what it was. So there's an agent involved, so it was 5,000 to them. There's an assignment fee of 7,500. We anticipate $5,000 worth of closing costs. It may not be that much for a house, in the mid 200s. It may be more like 3,000, 3,500, but we try to, to estimate. We always want to estimate a little bit more. Again, that's that 27. That was the rears, and then we have, we give ourselves, a buffer on each deal. for when we're looking for our buyer. We may not find a buyer in 30 days, 60 days. It may take us a little while because we want to get the right person in there. We just don't want to put anybody in the property. You'll get a lot of phone calls initially, people saying they could do this or that, but we have to send them to the RMLO, and we have to make sure that we're putting a qualified person in there that can give us, the type of money that we want down. Sometimes you have people that, well, I only have $10,000 down, but they look good in terms of their credit and the money that they make. But, I don't want to take $10,000 down. I want more than that. I want at least $20,000 to $25,000 on this to make sure that I have the right person in there that, we don't have to worry about. Obviously life happens to everybody, but, we feel strongly if we can get a good solid down payment and put them through that loan originator and make sure everything is there. So that is what, gets this total acquisition cost to just over $35,000 to actually take down the property and do what we need to do to get the right person in there.
Okay. Got it.
All right. So you have my contact information. I think I gave it to you yesterday. I had like 10 minutes left on this. So like I said, we usually go like 30, 40 minutes, something like that on Thursdays. If you have a deal or something like that, and maybe want to look at it from a different perspective, you're more than welcome to come on Thursdays, and we can kind of talk through it. Maybe some of the stuff that we do or how we structure it could make sense. It doesn't hurt to maybe get a second pair of eyeballs on things. Also, like I said, if you know somebody that, is looking to invest some money, we have some opportunities that are out there. We have things that are in the lower price band. Maybe somebody has under $20,000 they want to do something with. You may know somebody that has six figures that, maybe looking to get involved in certain things. So, on Thursdays, this is kind of where we do the deal review and, kind of go through it like we did today.
Okay. Sounds good. Yeah, I'm definitely interested in the starting off with the note investing versus creating the notes.
Okay.
But yeah, so I have your contact information, so I'll be sure to be in touch with you.
All right, appreciate it. And we'll be back next week. We go Tuesdays, Wednesdays, 8:30, as well as Thursday. Thursday we do the deal review. Tuesdays and Wednesdays we do more of just Q&A. So like I said, if you have something, in your own business you're thinking about, you have a question or whatever, or situation, we'll be here usually 30 minutes, no longer than about 30, 40 minutes. You can always check in on me either on Instagram, or, we can always send you the link for the Zoom if you want to join in on the Zoom.
All right, no doubt.
All right, buddy. Have a good night.
All right, thanks, you too.
Talk to you soon.